Index. Pankaj Murarka is with us with what he's making of the market, CEO and CIO at Renaissance Investment Managers. Pankaj, good to have you back here on the program. Prashant this side. Thank you for joining us. The Bank Nifty is at a new high. And hopefully this time, last time the 23,800 breakout in the Nifty did not last. Maybe it will now. Mood's pretty constructive out here. What are you doing, Pankaj, at Renaissance? And just tell us your outlook, near to medium term.
Sure. Morning, Prashant. Always a pleasure talking to you. I think, Prashant, we broadly remain constructive on Indian markets. We've held that view. I've held that view that whatever correction or pullback we've seen in the last 5 or 6 months, it's been more of a bull market correction than a change in broader trend on the market. The fact remains that we are coming out of a cyclical slowdown in the economy last year, where last year, if you look back, the March ending FY25, Nifty 50 earnings growth is just about 5%, probably the slowest earnings growth that we've seen in the last 5 years post-COVID. But I think that's in the base. Probably from here on, we'll see gradual improvement in earnings. Obviously, the world has seen that what lies ahead for the world is trade headwinds, significant trade headwinds. But probably in an environment like this, India is a relative winner because India is tariffed much lower than a lot of other competing economies. So that should help India slightly more medium term to long term. So our view overall remains fairly constructive from a broader market perspective. I think probably we should moderate our return expectations, but I still firmly believe that probably before the end of this calendar year, Nifty will make a new all-time high. So in that sense, we continue to remain positive on the markets.
What are your thoughts on IT? That's been the biggest drag since the beginning of the year. Growth is slowing down quite dramatically. But valuations too have corrected. And now some of the stocks like Infosys, for instance, is at its long-term valuation multiple. What's the call on IT, mid-cap and large-cap?
Well, as you rightly said, Reema, valuations have corrected and are pretty much, at least in the large cap companies, are closer to the levels where one would ideally want to invest into these companies. Having said that, we should concede that given the significant amount of uncertainty and these companies have called out that clients are holding back decisions. The biggest damage, I think, apart from everything else, and uncertainty around tariffs and what it does is it shakes CEO confidence globally. And once confidence of the CEO is shaken, obviously all investment decisions and everything is pushed back, and which is what these companies have even called out and they're experiencing where large deals or discretionary spends are pushed back. So I clearly think that the growth in the near term, at least over the next few quarters or probably next year, is impacted for the IT companies in that sense. There's a lot of fog on the windscreen and there's uncertainty. So until the fog is cleared, unlikely that we'll see these stocks performing. Having said that, as we said, in the large cap, at least valuations are far more reasonable or probably have become attractive. Some of the large companies are now quoting out or trading at dividend yields or free cash flow yields or earnings yields, which are as good as 5 or 6%. So probably that's the floor in terms of valuations for these companies. So I think it's time to selectively nibble, but I still think stock price performance probably would be more back-ended towards the second half of the year once fog on the windscreen is cleared.
Same of the consumption space. Valuations are not at long-term averages. They're still slightly elevated. And those long-term averages as well in the consumption space are elevated. A lot on the street believe that maybe the earlier axiom of FMCG stocks trading at a much higher multiple than the other parts of the market needs to be revisited. But on the ground, there have been signs of some recovery, especially on the rural front, and maybe some bit of incremental recovery coming in from the urban front as well, largely on account of all the SOPs that the government has given on the budget, etc. Do you believe that maybe some of these erstwhile companies are now taking charge, also looking a lot better than the D2C competitors, which have faced some sort of liquidity crunch?
Absolutely, Nigel. So I'm pretty positive, constructive, bullish, whichever way one way to frame it on the consumer stocks. Meaning, I think it's one sector which has underperformed big time in the last 5 years. If you look at post-COVID stock price performance, this is one of the biggest laggard sector. But I think after 5 years, we're getting to a stage where we are seeing early signs of recovery. And I think we are in for a very significant or meaningful recovery in consumption in the Indian economy over the next 2 or 3 years. Also, in a world where global trade is going to shrink, given that the largest buyer in the world, US, is going to withdraw, I think every economy or every country will have to look inwards towards driving growth. in India, we have stars aligning for a recovering consumption sector. One, we're coming out of a very low base of consumption in the last 2.5 years, where the PFCE, or as we call the private final consumption expenditure, growth has been about 5%, which is half of the long-term growth of 11.5%. More importantly, the government has done tax cuts in the last budget. That money will flow into the pockets of consumer. I think we're looking forward to a GST rationalization, which will again reduce GST tax on certain category of goods and again benefit consumption. And also, I think the rate cut cycle should also benefit consumption. So all of that, sum total, I think will lead to a meaningful recovery in consumption. So we remain pretty constructive. I think the two big sectors that I really think can outperform the market over the next 2 to 3 years is essentially private sector financials or financials broadly and consumption. So both these sectors have been laggard over the last 2 years, but I think they could be the leaders in this rally going forward as we build on this bull market from here on.
And how do you play consumption? Via traditional FMCG names, rural focused, urban focused, or discretionary names, or maybe entry-level auto names as well?
Well, given our growth bias for us, the natural bias is focused toward discretionary consumption. So we like names, and we own in our portfolio names like United Spirits and Jubilant Foods, to name a few, which we think will benefit as we see an uplift in consumer spending. But I would also say at this point of time, we're also buyers of staples as well, because for the very simple reason that we're coming out of a very low base of consumption over the last 2 years. When I said that, if you look at last 15 years, the aggregate private sector consumption or household consumption in India has grown ahead of nominal GDP growth. In the last 2 years, that growth is like half of nominal GDP. So because of very sharp inflation spike that we saw in the economy 2 years back, consumers have cut back on spending, including on staples. So now that inflation is moderating and there's rise in income levels, I think first thing the consumers will buy into is staples. So I see a very strong volume recovery in staples as well over the next 12 to 18 months. So at this point of time, our natural disposition is to own consumption across both staples and discretionary.
From your published portfolio, Pankaj, if you want to sort of talk about 2 or 3 ideas with full disclosure, what you're most constructive about, Pankaj, across the board. I mean, private, I understand financials and consumption, and we got into some detail there. But if you want to sort of talk about, overall, what you're most convinced about.
Yeah, so in a slowing economy where growth has moderated, I think the natural disposition for a growth bias investor like us is to look for outlier growth, which are the pockets of the economy where the growth can be significantly higher, and probably where can we make outlier returns. So clearly from our point of view, one we clearly see is capital markets or financial services as a sector which has strong drivers supported by savings and money moving into capital markets. So we own HDFC, AMC, and Motilal Oswal Financial Services to play the capital markets play. I continue to remain very constructive on the fintech opportunity in India. I still believe that 10 years out or 15 years out, one of the top 5 financial services company in India will be a fintech. And we've been holding Paytm for a long period of time. So I still continue to remain constructive. I think over the next 5 years, Paytm could do $1 billion of EBITDA. And I think some of these companies can actually lead to some outlier returns over the next, let's say, 1 to 2 year time horizon.
That's
as you rightly said, we own all of this in our portfolio, so the disclaimer follows.
No, full disclosure, absolutely. But good to put some names, right, to some of the ideas, as always. Pankaj, thank you very much for joining us. By the way,